Welcome back to the Educated HomeBuyer, where our goal is to help you buy right, borrow smart, and build wealth through real estate ownership and financing. The most recent news is showing that the median home price has declined. At the same time, we're seeing interest rates nearly double since the beginning of the year. That's leading to sellers reducing asking prices. Demand is drying up. So the real question at the moment is buying now or waiting? But really, what's the risk of buying in this market, Josh? I think that's the concern that most people have. It's not, the people that want to own a home still want to own a home, even though rates have gone up, even though prices have flattened. That doesn't change the desire to want to own a home. But the fear, there's a big fear in the market right now of buying a house. So that's what we're going to do today. We're going to talk about it in more detail, Josh. So let's talk about the uncertainty in the market, if you will.
Absolutely. And Jeb, the funny thing is this conversation is not exclusive to, but more specific to first-time buyers. If you already own a home and you're deciding or needing to move, you have an employer moving you from California to Washington, D.C., and you want to be a homeowner. You own a home now, you're looking at buying a home in another market. Yeah, markets can vary, but overall, the risks are similar in each one, and homeowners want to be homeowners. Who we're really talking to is folks that are just entering the market for the first time because they don't own a home. They have the opportunity to continue renting, and they generally have smaller down payments, smaller equity positions when they walk in to the home. So that the uncertainty for those folks is what happens next. What happens next in a number of factors, primarily home prices. But the biggest mover here, Jeb, that we've seen this year is interest rates. At the beginning of the year, the first quarter, home prices were still appreciating rapidly while rates went up from 3% to about 4.5% over 60 to 90 days. And you and I are looking like, this is kind of crazy. Why would this not impact home prices? And it almost was a panic of people feeling like they were going to miss out on those ultra low interest rates and came in and pushed prices up. So as rates have continued to go up through the year, we see less demand in the form of what we talk about willing versus able demand. We always have, especially here in Southern California, an unlimited supply of willing buyers, so willing demand for homes. But how many of them are able to do it at the current interest rates and the current home prices? So one element of that we have to be able to look at, it's almost impossible to answer, but where are interest rates going? If rates go from 6.5% to 8.5%, then home prices are probably going to struggle. If they normalize from 6.5% to 4.5%, I don't think they're going to continue going up like we saw in the first quarter when rates hit that level. But it increases the affordability. We have more able demand, more people who can take on those payments, and it gives us more support for prices. So that's the number one thing, is just where do interest rates go? But you do see, Jeb, a lot of talk in the media, in the news, social media especially, how home prices are going to crash. This is the highest home prices have ever been. They're going to crash. So when you hear that, Jeb, what's your response to that?
Well, I mean, I think we're going to talk about that. I mean, affordability is clearly an issue, right? I mean, that is the biggest concern at the moment because home prices aren't really declining. I mean, you hear the news, you see the media, home prices are down. Okay, well, we just found out the median home price is down 2% month over month. Now, I guess that's the second decline in a month over month reading in quite some time. So it's a shocking headline. But then when you look at where we were last year, we're still up over 12% in home price appreciation in just the last year alone, even with those declines. So home prices aren't crashing, but we both know it because we've been in the industry a long time, is that people worry more about the payment than they do the price, right? And so, payments or prices can be whatever. It's really the payment at what most home buyers are looking at. And so where they've seen the shock is in that monthly payment. We've talked about it in other podcasts and on video and what have you. It's up considerably. I think the latest stat I read was that the household the median income. So the median household income to make a principal and interest payment on the average home purchase is now requiring 36.6% of that household median income. This is the highest level we've seen, I think, since like 1985 or something along those lines. At the same time, it's a 73% increase in that monthly payment, from just a year ago where rates were much lower. So people are feeling that shock, and that's a concern. But on top of that, it's the crash talk. It's the uncertainty in the market. We've seen rates rise. We've seen the crash talk that's across all platforms. But then you've got inflation, right? I think this month probably going to see inflation go up again because gas prices have once again started to rise considerably. The Fed is coming out saying they're going to do whatever it takes, basically at any cost to, have this correction in the market, if you will. And a lot of people are taking that as they're willing to crash the market in order to get inflation down. We've talked about potential recessions. Where are we headed? A lot of people think we're in a recession now, and that those that don't think we're in one now thinks we're likely headed for one, which means additional job layoffs and people thinking that that's going to lead to additional inventory, distressed sales, foreclosures, and create this crash, if you will. Now, Josh, you asked the question a minute ago, what do I think about all of that? I think it's a lot of headlines. I think once you read into the data, there's less, there's clearly concerns in the market, with across all of the things that we just mentioned, but I'm not necessarily worried about a crash because you need excess inventory to create that crash. And I think we're in an environment where we've talked about it, where people are locked into their homes. Less people are going to be selling their homes. If you weren't going to sell your home at a 5.5% rate, why are you now going to put your home on the market at a 6.5% rate unless you have to sell that property? And most, people that I'm talking to are staying put, right? They're looking at the market going, it's more expensive to buy that house because the price is higher than what I paid on it or I paid for my house. And at the same time, the cost on that mortgage is nearly, 2-3 times what it would be because of interest rates increasing. So I don't think a crash is coming, a sideways movement to get us back to that trend, if you will, that we've talked about before. I think that's more realistic. So there are risks in buying, which we're going to talk about here in a minute. But, anything you want to add on that one, Josh?
Yeah, you said a couple of really important things there. The difference between a crash and a recession. If you want to make a headline, whether it's a social media post or if you're going to run a teaser before the next segment on CNBC or Fox News, whatever it is, you're going to talk about, is a housing crash coming? Crash is generally defined as a 20% or greater correction. We in Southern California have only had 2 of those. Both of them were characterized by greater than 40% of the homes in the multiple listing service being bank owned. And we hit like 70% in 2008. We do not have a recipe for that. Those are forced sales. We don't have the overbuilding that we had last time, although the builders are definitely sort of going to be feeling this more than the average home seller. If a home seller is not forced to sell, they can take their home off the market. Builder doesn't have that luxury. If you've built these homes and those timelines are 2, 3, 4 years out, and that inventory is coming to market this year, they will have to discount appropriately. But they also didn't overbuild nearly to the extent that they did, 10 years ago, 15 years ago, whatever that timeline was. So kind of wrapping up all of the things we said we have uncertainty on, we have rising interest rates. Well, why did rates rise? Inflation. Why did inflation get out of control? The Fed. We have a potential recession. Why? Because the Fed is fighting to try to get inflation under control. They have a dual mandate, full employment and 2% inflation. So they're trying to get inflation down to the 2% level. And it's going to be very difficult to do without increasing unemployment. Unemployment is currently at 3.7%. It would take an unemployment rate in the high 4s to get us under a 4% inflation rate, according to the best numbers that I've seen. And to get back down to 2%, we would need unemployment up over 6%. So not quite double, but about double what it is. Those are still historically very low unemployment levels, and they don't lead to distress in terms of people losing their homes. Because again, in the Great Recession 2008, we saw a 10, 11, 12% unemployment rate. So still very low long-term unemployment rates, but that's the uncertainty. And that's what we're trying to read and unwind in an environment where global economies are more intertwined than ever before, and we've got things like China and what Russia is doing in Ukraine, and
UK.
energy stuff, the stuff
Yep.
that we've got crushed the last few weeks because the UK, they decided that they were going to do some stimulatory things for their economy, which were read as inflationary, that were problematic for everyone. So it's harder than ever to project this stuff accurately, at least in the interim, to say what's going to happen in the next 90 days. If we look out 1, 3, 5 years, a little bit easier, but still not easy by any stretch.
Yeah, and I think there's ways that you can kind of insulate yourself, protect yourself a little bit when buying a house, which we'll talk about at the end of the video. But we've talked about kind of a market update, kind of a an overview of what's happening, macro, if you will. But that's a lot of those things, quite frankly, Josh, don't mean anything to anyone buying a house. They just want to buy a house because they need a house or want to become a homeowner for whatever reason, and they have different things in mind, at least in my opinion. I think some of the things they're worried about is overpaying for a house, right? Buying a house today and it being worth less tomorrow. That's a concern for a lot of people. Losing equity as soon as you buy that house. And both you and I know that you can't buy a house and look at the value tomorrow. It's real estate is for one, it's not really considered an investment, but it's something that you need to have. But secondly, or at least you need shelter. Rather, you could rent or you can own. And we've talked about the importance of owning. But in this, we're going to talk about owning. Why, not necessarily why home ownership is important, but we're not going to dive into the pros and cons of each. But in this episode, we're going to assume that you're buying a house, and so you can't look at the value of your property every day. You're looking at that monthly payment. Can you make that monthly payment? And that's what you do. You continue to make it. I mean, I've told the story of me buying a house in 2012. I bought because it was the right time in my life. My wife and I had just gotten married, had our first kid, and we were in a small apartment, a 2-bedroom apartment. There was really nowhere for the kid to play, and we're active people, like to be outside, and it just didn't work for us. And so we started, or in fact, my wife was really the one that got it going and found a property that she liked and ended up, working out. And today I look back, we've been in that house 10 years. It feels like, just a couple of years we started this whole journey, and now we're there. Home values have increased. I mean, I don't know what the percentage is. I mean, it's over 100% since we bought it. But I never looked at the value of that property, because I wasn't interested in selling it. I just needed a place to stay. I knew it was, close to being less expensive to own that property than it was to rent. And even, I can, confirm that today, looking at what it would cost to rent that property versus me going out and finding something else. But it was never about that. It was about, the right time in my life, Josh. So I know you have similar stories, but it's really the fear of these things is what, is creating this potential risk. And whether the risk is real or not, I mean, I guess that's to be determined.
Yeah, is it possible? It's absolutely possible. If you're a potential buyer, should you be aware of it? Should you take into account what are all the possible outcomes? Absolutely. Over time, we talk about over a long time horizon, over 10, 15, 20 years, we can count on about 4 to 4.5% appreciation. Would I count on that over the next 3 to 5 years, coming off of 2 years of double-digit appreciation? I probably wouldn't. Would I consider the possibility of home prices coming down? Yes, I would. What I would say is if you buy a $400,000 home, you're going to pay down about 1% of principal that first year, a little bit less than that. And it goes up every year. So if we have a 4, 5, 6, 7 year time horizon, you're going to pay some of it down. If the market goes sideways, if it dips a little bit, you're going to have a little bit of protection built in there. But that's the key thing. It's just having a longer term time horizon. Anyone who doesn't know that they're going to be in a property or could at least afford to stay in a property for 5 years, it increases the risk of the current market because something could change or go against you, and you get into a position where you don't necessarily have the equity to sell because you haven't had those years of principal pay down and any potential appreciation.
Yeah. So, I mean, so the risk is, yes, values could go down. Like you said, I mean, you're in a position where, if you have, you put 3.5%, 5% down and the market moves, down 5%, you're in a position where you essentially owe what's due on that mortgage. And when you go to sell that property, there's cost involved in selling that property, realtor fees, there's, title and escrow fees, depending on where you are, maybe attorney fees involved. And so you're in a position where you maybe owe more on that home than it's worth. And that's why we talk about, longer term time horizons, maybe buying a property that, fits your life, where you see yourself in not just right now, but where you see yourself in 3, 5 years from now. That way you're buying a property that's a little bit maybe more than you need, but you're able to grow into it, versus having to sell in a couple of years. Because, Josh, there in reality, home prices are likely to move sideways for a period of time. Does that mean they can't go up? No. Does it mean they can't go down? No. But because we've seen so much rapid appreciation, the nationwide numbers about 4.5% over a 65-year period, whereas in California it's more like 6.5, 7%, over that period of time. So, when you've seen 35, 40% in a 2-year period, it's realistic that you're going to see some pullbacks, just like a stock that goes up, substantially in a market over a short period of time. In order for that stock to continue going up long term, it's got to stabilize, it's got to pull back. And that's, in theory, what we're going to see in housing. And it could mean a sideways movement for 5 years. It could be a sideways movement for 10 years where you just don't see a lot of appreciation. But the key to having a 30-year fixed mortgage or any fixed rate mortgages is that you're buying, or you're paying down that principal every single month you make that payment. And so even though you're not coming in with a huge down payment, maybe up front, every single month you make that payment, you're paying down that principal. So over, a 5-10 year period in owning that home, you've made gains in that property, even in a market where homes didn't appreciate, because you've got money kind of going into that forced savings that we've talked about.
And you also fixed your housing payment. So regardless of what happens, I'm quite confident 5 years from now, rents are going to be higher than they are today. 5 years beyond that, they'll be higher still. Rents don't have the volatility that home prices have. One of the things that you look at over time is just the ratio of rents to home prices. Home prices are high relative to rents, but not as high as they've hit at other points, because rents have gone up so much over the last few years. So it is important that you manage and fix your housing costs. Owning is one of the best ways of doing it. That doesn't mean that you rush or make the decision to buy at a time that's not appropriate in your life. So, Jeb, what are some of the measures that a prospective first-time buyer should be looking at to determine whether it's reasonable for them to become a buyer in the current market?
Yeah, I mean, good question. I mean, I think, it being the right time in your life, we've talked about that. What does that even mean, Josh? Like, what's the right time in your life? It might be different for you than it is for me, right? For me, it might be the fact that, like I said, got married, had a kid, needed a yard, needed more space. And for me, what I was able to get at that price was essentially more than it was going to cost me. I mean, was less than it was going to cost me to rent a property. And I was able to be a homeowner. So in that case, it was the right move. Plus, we were planning on having more kids. We didn't know the time frame, but we knew where we wanted to be location wise. And so that was the right move for us. And it ended up being really, I mean, again, it sounds cliche, but it was really the right move, the right time in our life to make that happen. And we didn't have this, this ultimate plan that just kind of, that we were a certain date to do it or whatever, where some people have that. It was just, it felt right. We did the right thing and it ended up working out. But what I will say on that is you're still in a market with low inventory. Okay. Even though you've seen headlines about inventory increasing and what have you, inventory is more or less stabilized. And what I mean by that is it's not really going up or down in any significant manner at the moment. And so inventory is still traditionally, historically below the 2017, 2019 average, that 3-year average, which was considered more of a normal market. So we have way less inventory. So you might be looking at the market right now saying, I want to be a homeowner. I'm just not finding a property that fits what I want. Well, now's not the time, in my opinion, just to go buy a house, to get into a house, to be a homeowner. Even if it's the right time in your life, if you can't find the right one, then it's a waiting game until that home presents itself. In my opinion, you don't want to buy just to buy. You want to buy when it's the right time, and you also want to buy the right property for you and not be in that position because, again, by waiting a little bit, you might find a better home. But who knows? It might cost you a little bit more. It might cost you a little bit less, depending on what happens to rates. So just make sure you're buying the right house for you at the right time in your life. But we also talked about having that longer term time horizon. Josh, why do you need a longer term time horizon? What does
Well,
that even mean?
yeah. Well, let's look at the flip side of it, Jeb. You had two separate clients over the last 2, 3 years who bought a home that they were not happy with, and they sold within what, about a year?
Yeah.
And neither one of them got hurt because property values had gone up so much they actually both made money. But they made an impulsive decision, a home that was either a longer commute or that just didn't fit their needs. I had a client that bought, we talked about this on the show last week, that bought out in Hesperia. And they're like, no problem. We can make that commute into LA. And within like 8 months, they were like, this doesn't work. You can't spend 2.5 hours both ways on the way to work 5 days a week. You're talking literally like 25 hours of commute time on top of your 40+ hour work week. And none of those people got hurt because home values went up. They made a little money on their house, put money back in the bank, or went and bought a home.
Is that normal?
It's not normal. It's not normal. So let's say you and I talked about, the normal number is 4.5% appreciation, and that's an average. So some years are less, some years are more. Let's say you get one of the lesser years and your home value goes up 2%. My folks out in Hesperia did an FHA loan, so they put 3.5% down, but an FHA loan has a 1.75% upfront mortgage insurance premium that's financed. So they only have 1.75% in it to begin with. So let's say it goes up 3% in that year and they've hit their max. They're like, I either have to get a job that's going to be lower paying closer to the new home, or I have to get back closer to my job, which is the decision that they made. So with that, if you only have 1.75% equity at closing, you pay it down. So maybe you have 2.5 over the year and it went up 3%, you're at like 5.5%. If you're really, really lucky, you're going to break even on that. So if we're going into a market where we think it could be flat, there could even potentially be a little bit of a downturn year over year. That can't be an option. So you need to be even more sure on the way in that you're not settling for a home, that you're not settling for a location that's too far away from work, that's too far away from the kids' school. We have single parents who need to be close to a former spouse for handing the kids off, any number of things. That it is very important for you to be very deliberate and think your way through so that you have that 4, 5, 6 year time horizon to pay some principal down, hopefully get some appreciation, and be able to sell when the time comes for you to find another property.
No, and on top of that, having some money in the bank, right? Not using every single dollar you have for the down payment, every single dollar for the closing cost, like, having some reserves. And maybe that money is in equities or whatever, but just knowing that you have something that's tappable if you need it, I think is super important. And then really, I think the most important thing in the environment that we're headed into, I mean, this is always probably the most important, but more so in the uncertainty of the market, not stretching yourself on the payment, knowing what your payment is, and being comfortable with it every month. A lot of people, Josh, quite frankly, have a conversation with a lender and they say, Josh, I want to buy a house. What can I qualify for? And you say,
What can I afford?
Yeah, what
They
can I
ask me.
afford? And you say, well, you can purchase up to this amount, putting that down payment. And they go back and maybe they buy a house at that price, the max of what you told them, without ever creating a budget, because when you're qualifying them, Josh, you're using gross monthly income before taxes. So you're not factoring in grocery bills, you're not factoring in childcare, you're not factoring in, gas, any additional fees, any utilities in part of that calculation. And that's how people get in tough positions, right? Where, they might end up, being stretched every month. So create a budget before you have that conversation with Josh. Know what you're comfortable with, or any other lender rather, and know what you're comfortable with. And that way, again, you're doing what we're talking about here and not leveraging yourself and being in a position where you're house poor, if you will. And the last thing I would tell you, probably the best advice I can give in any conversation, is when you buy a house, if all of those other things that we talked about, you meet that criteria, just focus on making the payment every month and live your life. Don't worry about the value tomorrow, even if values have gone up. I mean, I would tell you that to somebody that bought a house 2 years ago. If you were looking at your value, just watching it increase every day, getting super excited, what did it matter? If unless you were selling that property, it had no bearing on the future, today, if you will. So just make sure you're comfortable. Don't worry about the value. Live your life. Josh, what other advice can we give?
Along those lines, just helping to quantify that. If you buy a $400,000 house and say that historical average is 4.5%, if we get half of that, 2% compounded over a 10-year time frame is going to get you about a 25% appreciation. So if you bought a $400,000 house, it's been worth about $500,000. You're going to put 3% down, 5% down. So you've got 20,000 equity when you walk in. But you're going to pay it down to the tune of about 1% a year. So say it drops 10, 11, 12% over the next 10 years. You're going to be sitting on 35% equity 10 years down the line. So if you do what Jeb said, buy a home you can be in for the long term that meets your needs today and tomorrow. Don't watch the daily fluctuations in the price. Make your payments and let inflation do its thing over the long haul. You will wake up and find yourself in a good position. And you will wonder, like I do, when someone new buys in my neighborhood and go, wow, that's crazy. Well, 15 years ago, we were the new people in the neighborhood and everyone's looking like, wow, that's a crazy price they paid for that home. That's what time does. When you stay in the home, you fix your housing cost, you make your payments, inflation increases the value, and you will find yourself in a good position with equity and a fixed housing payment. So really what you said, Jeb, is take the long view and don't focus on the day-to-day fluctuations, and make sure you're making a smart and deliberate decision on the way in.
There you go. And what we'll leave you with today is, don't wait to buy real estate and wait.